Hello everyone, Tim Erickson back here for another video. This week is actually, combining 2 weeks worth of updates on my challenge where I started with $10,000 investing on Robinhood. My goal is to turn it into $100,000 as quickly as possible. So for those who are new to the channel, please remember to subscribe so that you're notified when new videos are posted. My goal is to do at least one update a week on the challenge, as well as maybe another video on other investing related topics. It has been a little while since my last video, just got caught up in my real job and with my kids and all that. But that is what I'm hoping is actually more of the appeal of this channel, is that I am a normal guy who has a family, has a job, and am just doing the investing in my spare time and for fun. And I've developed some strategies that I think are both highly effective, have a very high probability of success, and are something that could be replicated by other part-time investors out there. So I'm hoping that you guys find these videos educational and are able to try implementing some of the things yourselves. But to dive right into the updates for this week, so as I mentioned, this is actually combining weeks 3 and 4 updates of the challenge. We are now 1 month into the challenge. As you'll see here on the top of my screen, my current balance $11,437 and change. If I click the 1 month tab, you will see that we did start the challenge on March 18th. Today is April 18th, so we are officially 1 month into the challenge. It is the weekend, so the market's not open, but this was the value as of when the market closed on Friday. So coming back to our 1 month tab, you'll see here that in the first month we're up 14.43%. in just that first month. Now that is, I believe, a phenomenal result and something to be very proud of. And it's also something that I think if we're able to replicate over and over throughout the course of this challenge, that we'll actually turn this into $100,000 a lot faster than people might think. So, one of the things that I really pride myself on here, as I said earlier, is that these are strategies that have a very high probability of success and are things that can be duplicated by anybody who takes the time just to learn the basics about trading option spreads. So for those who are new to the channel, I have done other videos explaining in depth the option spread trading strategies that we use, so please check out the channel to learn more about those. And I will give kind of a quick synopsis of it as I update you here also. But one thing I wanted to pivot to and talk about real quick is, if we replicate this kind of performance where we gain 14.43% in a month, how quickly can we expect to accomplish our goal of turning $10,000 into $100,000? So I opened up here an Excel spreadsheet where I just want to do a little thought experiment here. Now, I'm not saying that we are always going to have that kind of success every month. There will probably be some down months along the road just because the market is cyclical and does move down sometimes. But just as a thought experiment, if we start with $10,000 and I have this column here just representing each month that we compound, because since I've now been doing the challenge a month, I want to see if we replicate that kind of return, how quickly can we expect to get there. So if I start with $10,000 and I increase that by 14.43%, means I'm going to multiply it by 1.1443. Then you'll see here at the end of that month I'd have 11,443. So it's showing $6 more than I currently have, but that's just because rounding, I guess, on the percentages. So I guess if I change that to 2.5, it'd probably be a little closer. Or actually, I think the main reason it's showing less is the after hours stuff, but it's close enough. It's off by $6, so you guys get the idea. So if we are to replicate this kind of return, 14.43% every month on Excel, all I have to do is drag down my formula here, and you'll see how quickly that works. So in just over 17 months, we'll have reached 100,000, assuming we can replicate these returns every month. Less than a year and a half, right? Which would really be phenomenal. If you think about it, you get 10x your money in a year and a half. That almost sounds too good to be true, right? Well, I guess I want to now temper your expectations a little bit and say, yeah, that probably is too good to be true, because there will be some down months along the way, and if you have just one down month along here, it'll probably set you back 2 or 3 months as far as actually reaching that goal. But just wanted to point out that making these kind of returns, if you are consistently making those returns, you will make a lot of money investing in the stock market. So if you have a perfect run where you don't have any down months at all and make that kind of return every single month, then you're going to accomplish this goal in just under a year and a half. Now, realistically, like I said, because some months might not have quite as good of gains and or be down months, realistically I expect it to take longer than that, but even still, even if it takes 3 years, if it takes twice as long, that's a phenomenal rate of return. To 10x your initial investment in 3 years, if you do that a couple of times and you'll be rich very quickly. So that was just something I wanted to point out about how well the challenge has started off, how pleased I am, and hopefully as we progress along in the months, we'll continue to duplicate that kind of success, and more people will become believers in these strategies. So pivoting back to our account here to update you on the trades for the week. If you come over here into my positions, you'll see I have a lot fewer positions expiring April 30th. I'm down to just 2. I had a bunch more previously. That's because I closed out a lot of those positions. So if I come over to my messages, I can kind of show you those. So starting on, well, I guess starting the week here, if we come back, you see on April 12th, I received my first dividend of $9.36. And then I opened up another SPY contract. This one I only got $4, but because I already had, this was a call credit spread, because I already had a put credit spread, it didn't require any extra collateral. So just one more small amount there that I was trying to gain. But then if you come up here, these next 3 orders, you can see here, actually I guess the next 4, I closed a number of contracts. So I closed 2 of these ET contracts for a price of $3. I think I had averaged like $7.3 per contract when I opened them, so a little over half my profit locked up. They did expire April 30th, which is now not too far away, but I felt like really I just closed these because I wanted to release the collateral. I had 2 contracts at 50 collateral each. That was $100 collateral that was tied up on those contracts, and I was able to replace that and open some new positions, which I'll talk about later. But you'll see I also closed some CVS puts for just $3 each. I think those ones I received 9 when I opened them, so 2/3 of my profit. These AbbVie ones I closed for a price of $21. I don't remember exactly what I got, but it was definitely over 40. It might have been 42 or something when I opened them. But these ones I closed because it was quite a bit ways further from their expiration date. I think it wasn't until May or June, the end of May or June. So close those ones again, mostly because I just wanted to release the collateral. These ones, the 2 contracts combined had $500 collateral. I paid $21 per contract, so I paid $42 to release that $500. And then lastly, I closed these 10 enterprise products spreads for $2 each. I don't remember the exact credit I got, but it was probably in the $8 or $9 range. But again, I had 10 contracts, and it was $500 collateral. Yeah, so releasing $500 collateral for a cost of $20. So what did I do with that collateral? Well, this time I went in and I opened a bunch of new puts, this time on Viacom, CBS. As you see here, I have 4 of these spreads in May and 5 of these in June, which netted me quite a large number of credits. As you'll see here, these 4, if I click on it, I received $196 for opening these positions. It is a spread of $2.50, as you'll see here. And for those who are new to the channel, what this means is I did an option spread. So I traded 2 options simultaneously. What I did is I sold the $35 put that expires on May 21st, and I bought the $32.50 put with the same expiration date. So the reason I do that is it limits my potential losses to the difference between these 2 strike prices, less the credit I get when I open the trade. So you see here I have -4, means I have 4 contracts. We are at $2.50 spread, so $250 collateral per contract times 4 means I have $1,000 collateral here. I received $196 credit when I opened it, which is nearly a 20% of the collateral amount as a credit. They expire in 1 month basically, just over, so May 21st. So if these expire worthless, then I'll have made almost 20% of my money in a month, which beats the 14% rate we averaged in our first month here. But anyways, so these were some contracts I opened. Again, I got quite a large credit for doing so, which made up for all the money I paid to close the other ones. I also opened these ones, which were just a little bit further out expiration wise. Oops, that's the same one, sorry. No, oops, keep clicking on the wrong thing. Scroll down, there we go. Opened Viacom in June expirations, which these ones, they have different strike prices available, so I only did a $1 spread on these ones, but still with a higher price of $35 and then the lower price at $34. So that $1 difference means I only need 100 collateral for each of these. I did 5 contracts, so again, that is 500 collateral. And I got $125 credit, so that means I got $25 per contract, and again, only $100 collateral per contract means I actually got 25% of my collateral back as a credit here. So these ones I opened, they're a little bit further out, so we got 2 months until expiration on these ones, but a slightly higher credit to compensate. And I did that just to kind of spread out the risk a little bit. But I want to come in and talk really briefly about why I chose to open this position. So if I look at the stock for Viacom CBS, and more specifically, if I look a month back, you'll actually see this big downward spike. Now, normally this is not what you like to see in a stock, right? You don't want to see this huge cliff where the stock just tumbling in value. But I want to talk a little bit about why that's happening with this one. So there was a lot of stories in the news recently that talked about a particular hedge fund that was a private hedge fund owned by Bill, I think it was Huang or something like that. But anyways, it was Archegos was the name of his fund, and he was way heavily invested into this company, and he had used a lot of leverage to do it. So he had gone to all the big banks on Wall Street, borrowed hundreds of millions of dollars, if not billions, and just purchased up as much of this stock as he could. So this run up in price, where it ran up to $100 per share, most people now tend to think that was never really the intrinsic market value of the stock. It was just artificially being inflated by one guy pumping billions of dollars into buying shares, right? And what actually happened to him is when the stock price dropped a little bit, his lenders all of a sudden became worried that his positions would not be worth enough to cover their loans to him, and so they triggered what they call margin calls, where they actually force sold his positions. And literally you had this forced selling of billions of dollars of this stock, causing the price to just plummet. All right. You see here, it kind of initially was bouncing up and down around 45, and then it's just kind of slowly trickled its way down to 40, ending just, I guess, a little under 40, 39 and change. But I guess my thesis on why I decided to open my positions on this stock is, just as I don't think these values were truly represented the intrinsic value of the company, I don't think these values down here do either, because I think this has been the process of this company being oversold by his lenders forcefully selling his positions. I think as the dust settles there's a good chance the price stabilizes and or even recovers a little bit. Now, that's not guaranteed. I encourage everybody else before they invest to do their own research and become aware of the risks before you do so, but my thesis with my trades was essentially this. My strategy is the put credit spread strategy, right? Which, if I come over to the options, I'm basically betting the stock is not going to drop below a certain point. And so why did I choose the level I did? Well, because I feel like where the share price is now is a decent valuation for the company. As we go throughout this challenge, you guys will hear me talk about valuation a lot. And I figure if the sharks on Shark Tank care about valuation, then I should as an investor too. And so at these current prices, this stock is actually now trading at a better than a 10 price to earnings ratio. So that is considered a relatively low valuation for a pretty well established company that produces lots of earnings. So they earned over $4 a share last year, are expected to again this year. And again, I just think that while it might not have really ever been worth 100, I also struggle to see why it should be worth less than 40, at least to my mind, which is why I was willing to put my money where my mouth was and invest a little. So what I did, again, I sold the 35 puts that expired in both May 21st and in the middle of June. And then I bought a lower put to cover that. So the way, for those who are new to the channel, I'll just show you how that's constructed. But basically I would come in here, I would click the May expiration option, I would click to sell the $35 put, and then I would click to buy the put below that. And as you will see here, this gives you the estimated credit of $48. It does tell you that somewhere that you would need the collateral needed to make the trade, but it also, recently Robinhood came out with these nifty charts that kind of help demonstrate exactly what this trade is about. So if you see here, this line representing the current market price, basically everything in the green is our potential profit and everything in the red is the potential losses. So at any market price above $35, we make our max profit, which in this case is $48. If the market price drops below that, you have small profits between $34.52 and $35. And again, that's because we receive $48 credit when we open it. So if you subtract 48 cents from 35, you get this amount, $34.52. So any price in between that small range, you make a small profit, but not as much as you otherwise would have. And any price below $34.52 is where you start to incur some losses, right? So if the stock were to close $33, you'd have an expected loss of $152, all the way down to a max expected loss of $202. And so why is that the max? Well, because any price lower than $32.50, we bought a put for that price. So we could turn around and sell somebody the shares at that price to not have any more downside risk below that. So these charts that Robinhood recently came out with, I think, can help beginners kind of understand the risks of the trade. And now somebody might say, well, that doesn't seem like a very good trade. Your max profit's $48 and your max loss is $202. Your max loss is a little over 4 times what your max profit is. That's not a very good deal. And I would counter that with saying that it is a good deal because the probability of the profit is much higher than the probability of a loss, right? It's not a 50-50 proposition. So that's one of the reasons why I really like this strategy and why I think it's super powerful, is because even if this price continues to drop, as long as it stays above $35, the options expire worthless and I make my max profit. And the other reason I like these strategies is, again, because we have an expiration date on them. It's not that it's an ongoing thing forever, but once they expire worthless, then our collateral is released and off we go. And so you guys hear me talk about collateral a lot, and for those who watched my other videos explaining the put credit spread strategy, I'm sure you already understand it. But basically, because the difference in these two prices is $2.50 and each contract is for 100 shares, if you multiply 250 times 100, gives you $250. That's the max collateral that I would need to open the trade, and the reason being, if we did incur the max loss, we would have to pay that amount to actually close out the position, $250. Now it says the max loss is $202, not $250, because again, they pay us $48 when this trade is opened. So we receive $48 no matter what. That's ours regardless of what happens. They may come back and charge us $250 if the stock price plummets all the way below $32.50 in this case, which would, if you go minus $250 and add back the $48 received, gives us that max loss of $202. So now the reason why I think this strategy is really appealing is, again, this credit here is basically almost 20% of the collateral that you need to open the trade, and these contracts expire in just a month. So assuming we're correct and the price of Viacom stays above $35 up until May 21st, when these expire worthless, that $250 collateral that's held is then released, and we can go open a new position and receive another credit and continue to just kind of churn through and recycle that collateral over and over again. So you can see how you can make those really nice compounding returns. If you can make 20% on that $250 in just a month, and then do that every month throughout the year, all of a sudden, and not very long at all, you're going to have really phenomenal returns. And so looking at my challenge, that's what I've been doing. That's the main way that I've been able to add value to this portfolio. I have been relatively lucky, and some of the positions that I've opened too have gone up in value, and I'll show you guys that in a second. But the last thing I just wanted to mention is, in addition to opening those puts on Viacom, I took those credits I received and I bought 7 shares myself. Again, because I think it is an attractive valuation for the company today. They do pay a very small dividend, a little over 2%, but really I'm betting that the stock price decline is not going to continue, and we will see it start to rebound at some point. Now, that's my opinion. Again, I'm not a financial advisor, so please, everyone, do your own research. But as you see here, I bought 7 shares, cost me $280, so I'm down $5 on these shares. But $280, that's not money that I added to my account. That's all money just received by either my dividends, which were not a ton, but were a little bit, and mostly the credits received when I opened all these new positions. So if I click on my buying power, you guys see here, currently sitting on $26 of cash, and I have $5,650 in options collateral for all of my positions, leaving me with this net buying power amount. Now, because options are a little more volatile than just buying equities, if I were to go try and open options, I think they'd only give me half of this buying power amount as collateral available for options, but that's okay. We're pretty close to the max on where I want to be on options collateral. You may see me open a few positions this week, but probably nothing too crazy unless I decide to close out other positions also. But so that's the update on those for the week. If we come over here into the account, you can see here currently Viacom's our only negative position. We did have small losses in Bristol Myers and CVS, I think, in the last update. You'll see CVS has turned positive. McKesson is still positive, although I think not as much as it once was. AbbVie has also, recovered nicely. AGNC is performing well, and Bristol Myers has really had a nice turnaround from, a break-even-ish to a small loss before to now being up $75, up 132 in Lockheed Martin, and 243 in Oracle. So Oracle has just been phenomenal. We're already up massively in this position. In fact, if I click on it, let's see if it'll load. You'll see here I'm up 18% in just a month on one position. So this one's performed very well for me. In hindsight, obviously wish I had bought more, but we are trying to diversify, and I'm sure there'll be other months where that one pulls back and other stocks do well and whatever. All in all, very pleased with how the portfolio is going. Again, we added 7 shares of Viacom this time. I will probably look to continue to add a few more as long as the price stays low. I do try and have a relatively balanced portfolio, and our other positions are all over $1,000. This one's only got $280, again because that's the cash we had available from our spreads, but that was kind of the big update for this week. So this is probably the most changes I've been able to report anytime recently on the challenge. And I guess really quick, the other thing I'll show you is the dividends. So if I come over to history and click on dividends, you'll see here besides the dividend from AGNC we received, that was $9.36, we received $18.86 from WP Carey. And we have these other pending dividends that are paid, sometime over the next month or so, April 22nd, May 3rd, May 14th. AGNC actually pays this amount monthly, so you could expect on May 12th to have that amount filled back in there. We do have several other dividend dates coming up with, I guess the big one being CVS and another one from AGNC. So not huge gains yet in the dividend column, but definitely stuff that is going to start to be significant and add up over time, especially as we continue to add to these positions and buy more shares. So very pleased with the way the challenge is going so far. If you guys are enjoying the video, please consider leaving a like. Please consider leaving a comment below if you have any other questions about anything, any stocks you want me to check out and spout off on or give my opinions on. And tell me how this has been going for you if you've been trying to implement the strategy yourself. I'm very eager and curious to hear from you guys what's going on, and I look forward to catching up with you guys next time.